Today on Escape the Clock, we're aiming to answer the question, if every paycheck has a ceiling, how do you build the kind of wealth that doesn't? Did you know that nearly 9 out of 10 salespeople say they are burned out at work? And more than half are already looking for the door. It's natural to grind harder when you feel that resistance pushing you back. What happens when that resistance is an unbreakable ceiling? What do you do when working harder stops working? Today's guest knows that ceiling from the inside. Leo Young came to this country as a first-generation immigrant with no playbook and no mentors. He clawed his way to the #1 regional sales spot at Tesla, and then the grind nearly broke him. So he stopped trying to earn his way out and started trying to own his own way. Today, he runs Cornell Communities, a real estate firm with more than $75 million in transactions across 8 states, built on one of the most overlooked asset classes in America. So today, we get into what flipped the switch from earning to owning, why he bet on the corner of real estate that most investors ignore, and what he wishes more high earners understood about the difference between making money and building freedom. Stay tuned to learn how a top salesperson traded the Tesla treadmill for the most overlooked corner of American real estate and escape the clock. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. Most people on the path to financial independence are running on a strategy. Earn more, save more, invest the difference, and eventually let the math do the work. It's a perfectly reasonable plan. It's also a slow one, especially for people whose income is tied to their performance, their hours, or their physical presence at a job. The problem with that strategy is that it depends on a single engine, the paycheck. And every paycheck has a ceiling. The harder reality is that most high earners do not have a wealth problem. They have a vehicle problem. Earning $250,000 a year and saving 15% of it sounds like a winning formula. But after taxes, lifestyle, and the slow inflation of expenses that come with every promotion, the actual surplus is often a fraction of what it looks like on paper. Meanwhile, the people quietly building real wealth in the country are usually doing it the same way, by owning income-producing assets that pay them regardless of how many hours they personally clock. The fastest way to find a vehicle is to look where most people are not. And one of the most overlooked vehicles in America right now is the manufactured housing community. 22 million Americans live in them. There are roughly 44,000 communities across the country supporting 4.3 million home sites. And as the affordable housing crisis deepens, with the U.S. now short more than 7 million affordable rental units for low-income households, these communities are becoming one of the most essential and structurally undervalued asset classes in the country. This is where today's guest has decided to put his bet. Leo Young is a first-generation immigrant, the founder and managing partner of Cornell Communities, and a former member of the acquisitions team at a $4.5 billion private equity fund. Before all that, he was the #1 regional salesperson at Tesla, a role that taught him how to perform at the highest level inside someone else's machine. And what he learned during that climb is what eventually drove him out of it. And today, his firm revitalizes manufactured housing communities across 8 states and aims to provide affordable, dignified housing while generating disciplined, risk-adjusted returns for investors. His mission, in his own words, is to positively impact the lives of 1 million people through real estate. Leo, welcome to Escape the Clock.
Thanks so much for having me on, Dan. Very excited to be here. And I love that intro.
Thanks. I'm really happy to chat with you. I'm really interested to learn more about this. Before we get into that, I would love to hear, because you have such a fascinating background, and plus you've kind of lived in these 3 different financial worlds. You had that high pressure commission grind at Tesla. You worked for the institutional grind for private equity, and now you're doing kind of this more real estate focused thing yourself. So a lot of people maybe experience one of those types of things at best, and you've done it all. So I'd love for you to take us back to where this all started and what drove a first generation kid like yourself into like a high stakes careers like such as Tesla in the first place.
I think the story, if you look backwards, it all makes sense, right? There's a reason for every one of your kind of pivots, but moving forward, like none of it made sense. You know, I'm a first generation immigrant. Like I didn't really have any playbooks or mentors kind of being like, hey, Leo, like this is how you got to do it. This is how you make money. This is how you get career like fulfillment or something. I had to figure out a lot of this on my own, and just through the power of the internet and Reddit and all these different things, I sort of found the different paths that I was on. So for me, back in college, I mean, I was studying finance. I was always very interested into investments because to me, investments is like the real world version of philosophy. I like to think. And, you know, when you're thinking like, okay, is this company going to do well? Why is it going to do well? You know, how is it positioned for the future? That's kind of where my curiosity guided me. So after college, I was trying to get a finance job. I didn't really get one that I liked. And along came this opportunity to be in sales at Tesla. And for me, I saw it a kind of scary, but also important opportunity for me to really hone in my sales skills. I mean, at the time, I still am an introvert by nature. And just like, I think learning how to communicate a point, how to convince others of like the benefits of, you know, what you're saying has been a really helpful skill. So did that, ended up getting a lot more than I bargained for in good and bad. You know, I learned a lot of useful skills that kind of inform me as an entrepreneur today in terms of like grit, you know, persistence, all that stuff, but also got kind of burnt out. When I was there, the company almost went bankrupt for like the most recent time in history, and everyone was getting worked extra hard. And I was like, man, I need to find a way to build wealth and like build some level of income that doesn't depend on me clocking in and out. Because it was just so painful, man. Like when your days kind of just like blur in, you're like, what am I doing? But like at the same time, like everyone's got this sadistic appetite for work. You know, everyone was like on point there. Yeah. So doing that, getting involved into real estate, doing a ton of research in advance, becoming a passive investor into some apartment buildings, and then kind of the light bulb went off. So fully went into real estate, got my license, was learning and earning, and then got recruited by a real estate fund, helping them deploy capital, and then now starting my own.
What was money like in your house growing up? When did you start to notice how your parents' relationship with it, and how did that kind of influence your own financial career?
I grew up in Hong Kong, so it was very different. Like people's relationship with money is very different there. I would say, you know, the Asian kind of way of thinking is like save every dollar that you can and buy real estate. That was just like what people were taught there. For me growing up, not understanding the value of money, I thought we were poor. We didn't really have any overages for anything. I couldn't ever get any cool toys. I was always like pissed off. Like, why, mom? Like, why can't I get this? And, you know, at some point I learned it's because of a mortgage. So we were house poor. And my family went through the housing crisis in Asia. Our properties were underwater. And, you know, back in 2008, here in America, people are just, yeah, screw it. Like declare bankruptcy. You're good. There, you know, they kind of stuck with it. It was tough. That kind of led to this mentality of financial scarcity in the household. Fast forward to being in America, learning, okay, there's a different way of viewing things here. People don't really care about how much they spend because they care about how much they earn. And that was kind of a different mentality shift and kind of learning into that. I mean, still to this day, I'm quite frugal, and I do think it is a superpower in business because me as a business owner, I can have a longer runway than someone in the same position can have because I'm able to get that much more out of my resources, but still learning to focus on the upside rather than the downside. That was something.
Seeing your parents struggle like that, did that try to influence how you were working? Like, were you just trying to provide back for your parents, seeing all the sacrifice and efforts they were putting in? Or was this more of an internal thing that you just had regardless?
Yeah, I'm super grateful for my parents. They're not the conventional parents, certainly not like the conventional immigrant parents that's like, hey, man, like you have to get good grades in school, that stereotype. My parents just wanted me to be happy. And looking back, that was honestly, it was so profound that they just wanted me to do that. But I kind of just gravitated towards, I need to prove to the world that this bet that my parents put on me was worthwhile. And how do I make their bet successful? It's like, I provide enough value to the world that the world's like, wow, okay, this is an example of a life well lived. So that sort of informed me into doing what I do. I always want to be creating and giving value to the world, kind of amplifying the value that I received, the lesson that I've learned along the way, and just share it with the world. Hopefully shortcut people's growth and inspire people to do better.
There's this massive wealth divide in the United States where the top 10% of US households hold 67% of all household wealth with an average net worth of $8.1 million, where the bottom 50% hold just 2.5% of wealth, averaging only $60,000. So it's a massive gap, and it's more than just income, it's assets. So you were mentioning when you're at Tesla, you're going through the grind, you're feeling that burnout, and you start realizing I got to do something else. I can't just rely on this forever. And you mentioned apartments. investments. When did it really click for you that you had to do more than just work for income your whole life, regardless how good you were at it?
Yeah, for one reason or the other, you could chalk it up to being blessed in a very serendipitous position. But, for me, I was never paid well on paper. I remember graduating, I was wanting to find a finance job. I had this certain number in my mind and I didn't get a job with that number. We got really close, got the job offer. It was like a few $1,000s off. I told the recruiter, no, this number or I'm out. And then so I took a much lower pay at Tesla. And that kind of just inadvertently taught me the value or like the importance of value, not so much working for a paycheck, but more so providing value and capturing a bit of the upside. Because the thing with Tesla is that they pay less than their peers do, like than the Amazons of the world, all the other competitors of tech companies and whatnot. But they gave you equity. They gave you shares, which ended up doing pretty good. At the time, like to us, like working at the company, we're like, man, this is the best thing since sliced bread. Like, why is no one else believing in us? But surely enough, a few years later, people caught on. People are like, whoa, this guy's smart. He's onto something.
I bought at the IPO because it was the first real splurge I ever made, was buying myself a Tesla, because I was commuting 3 hours a day. And I'm like, this thing's going to eventually be able to drive itself. That sounds like a great investment. This sounds so modern, so futuristic. And I remember buying a bunch of shares and it did really well. And it was a community. There was like a mindset with Tesla back then, for sure. I can imagine on the inside, you really felt that.
Yeah. I mean, it was like very polarizing even back then, because either love Tesla or you don't know about it / you hate it. People would come in and be like, oh, like Tesla's owned by Toyota, right? Oh, like these are the cars that catch fire, right? All this, that. Oh, like your CEO is smoking weed on the Joe Rogan podcast, right? And like, yeah, all right. Things like that. But yeah, I mean, so back to the main point is learning to capture the value that you create is important. It's not so much about the income. It's more so about owning a piece of the machine that's worth something. So that was one piece into it. Then learning about real estate, like, hey, you want to own a higher unit count instead of like a threeplex, one tenant leaves, that 30% of your rent roll gone. Owning a piece of a larger building, getting the benefits of that. And then, starting my own business is like, okay, well, you're owning this kind of machine, this platform, instead of getting paid a dollar amount. Because I think, and this is one very limited perspective, call it, is that, part of the reason driving kind of the wealth inequality is there's people working for money, and then there's people that are working for the machine that makes the money. When you're looking at commercial real estate, for example, it's valued on a function of the profitability. You apply a multiple to it. So your money multiplies because of that, not just dollar for dollar. If you make 100 grand, that's it. As opposed to if this company makes 100 grand, it's probably worth 500,000. So knowing that dynamic is really important.
Yeah, that makes a lot of sense. I remember when I was getting my wealth management degree, we had this kind of analogy about income being the fruit from the tree and, trying to get as much fruit as you can. But if you own the tree, now you have that asset, you can do much better because you have more access to the fruit. And I do think that there is a disparity between people working harder for income and missing out on owning assets. Most people only try to own like their primary residence and don't usually go further than that. That mortgage can just be a lifetime of debt for a lot of people. So you eventually came upon manufactured housing communities, and that's fascinating. I don't know a ton about that. I do know that there are 22 million Americans living in them across the United States, 44,000 communities. So it's significant. I would love to hear what led you to that and what you noticed there that made you feel like I'm going to actually do something about this because people are missing something.
It was kind of by chance. So I was working at the fund at the time. I had another friend who was also working at another fund. His fund specialized in mobile home parks. He learned the ins and outs of the industry, what made it compelling. He wanted to do his own thing. And, he sat me down one day. He's like, Leo, let me walk you through the investment thesis. This is why it makes sense. Basically, this is the lowest cost form of housing that's not government subsidized. So you don't really need to depend on the government to provide this level of affordable housing. There's no cheaper way to go. Like people can't move down from here. So there always will be the demand. So it's very recession resilient in that regard. So I'm like, okay, that makes a lot of sense. Cash flow is pretty good because it's a simple business model because we want the residents to own their own homes and take care of the maintenance rather than the property owner. But on the social side too, because for me, I work super hard and like I always want to make sure that I'm furthering a cause and a mission. So, when I was at Tesla, the kind of sustainability mission meant meant a lot to me growing up in Hong Kong, kind of firsthand seeing the power pollution. Like I get hives when I go back home. Like it sucks. Like pollution's so bad. It's so humid. Like my skin itches and stuff. So I'm like, okay, well, let's spread the ideology of like, hey, like you can make renewable energy good and actually effective. The impact angle with mobile home parks is that you're providing affordable housing, you're sustaining it. Because what people don't know is that, yes, this is affordable, but by nature, it's also old. Because a lot of these properties, they're 50, 70 plus years old. They have like failing infrastructure. They might get condemned. And when they get condemned, everyone gets displaced. You have like 50 families that need to find new housing. Like, where are they going to go? Somewhere more expensive. So, for us to be able to provide and continue that, it was important to me too.
So what are some of the basic economics of investing in and operating communities like this?
So the kind of business model is that we like to own the land and the infrastructure. You'll see in the virtual background behind me, these mobile homes, as the name suggests and misleads, it's not really mobile because they're set on concrete. They have skirting and stuff. It takes like thousands of dollars to move them. So people usually come here, they stay for 10 plus years at a time. So for us, it's, hey, let's just maintain the infrastructure. We maintain the roads, the utilities, common areas and stuff, give them a good place to live. Depending on the quality of it, there's some really nice ones that feel just like a subdivision. So that's kind of our goal. We raise money from investors, we put in the money that's needed, we budget for it so that we can give these folks a good place to live.
Are there any like zoning requirements or anything in particular that usually comes up for these things? Like what kind of hurdles do you normally work with?
One of the biggest hurdles is zoning, and also why these properties are so old is because these are typically grandfathered in. So meaning that municipalities are not approving any more of these properties. And that's because the math doesn't make sense for them, because it costs far more to service a household in a mobile home park than they provide in tax revenue. Because if you think about it, for one household, they might pay $1,000 in taxes per year compared to $5,000, $10,000 for servicing them, depending on the municipality, because you have the schooling system. There's like 2-3 kids in these, and like each kid costs the school money. There's utilities, fire, EMT, police, et cetera. So it's a lot of burden on the resources. So yeah, that's why we buy existing communities to revitalize them, breathe new life into it.
Well, that's cool. There has been some scrutiny around the corporate ownership versus the social welfare of people in this space, especially when it comes to rent and cost for people who don't really have a lot of means. How do you handle that tension as an operator, knowing that these people are just looking for a home?
That's such an important point, because like there is a lot of nuances, because when you're providing this kind of product like affordable housing, you want to provide housing that is compelling, that's affordable as well. But also you want to budget for the necessary things to go back into the property. There's kind of two camps. One is the mom and pops. They've owned this for 30, 40 years. The money just goes right into their pocket. So they're like, yeah, they keep rent super low because they don't really put the money back. And then, these properties get condemned. You're like, oh crap. Like then these folks are just out. As opposed to on the other side, they're like, hey, if we have the ability to raise rents, why not? In my opinion, we try not to do that because we see our residents as a stakeholder as well. So we want to see like what makes sense, what is fair in the marketplace. We do like market research to see like, okay, what's housing costs? What's an all-in kind of monthly payment for each resident to make sure that it's compelling. So yeah, we take extra steps like that.
So assume like myself or someone was interested and I have some capital. I want to get involved here, but I don't know a lot about the space. How do you typically guide someone through doing this well? And what type of gotchas or landmines do you help people avoid?
Yeah, I assume you're talking about the investing side. So a lot of our investors, they're people that have a daytime job, they have a family, and they're like, well, hey, I want to continue doing what I do best and leverage other people for what they do best. So they invest with us, we make their money work for them. And to learn about passive investing, it's great because a lot of the knowledge is kind of one-time learn. Like once you learn how the ins and outs work, how people get paid and when, and about the asset class, that's pretty much all you need. Because once you invest the capital capital. You're hands off. Our team does everything from finding the deal, closing it, signing on to the loans, managing the property day to day, big picture projects, etc. So it's really convenient. And I would say educating yourself, there's a few different ways. So I personally started from reading books and blogs, like BiggerPockets, like YouTube, different like social media channels and stuff. But now there's AI. And with AI, it's convenient, but then you also want to, especially like if it's citing certain things, you want to make sure it's not like hallucinating or like citing wrong facts. So that's another way. And then of course, actually talking to the investment group. They usually have investor educational materials, which we do as well. We're always happy to share. I think the one distinction I will say, Dan, is for me, because I've invested as a passive investor and I still do, I always try to be the investment firm's general partner that I wish I had as a limited partner. So for us, we emphasize a lot on investor education, just like sharing resources for them to become more informed themselves, whether or not they invest with us. Like we just want to improve them on their journey.
Yeah, passive income's the dream for people doing what we're trying to do here, right? People who are on the path of financial freedom are probably investing towards some type of passive investment returns, some areas, and may be interested in something like this. So what types of returns, or let's start with capital, like what is like a typical barrier of entry for someone who might be considering something like this as an investor? And I know you can't guarantee returns, but like generally, what type of returns could people hope for in this area?
Yeah. So the first answer, as far as the investment amounts, so we're in the private equity world. Check sizes really differ. And for us, we try to keep it as small as we can within reason, because obviously like there's running costs to service each investor and whatnot. So we keep it around 50,000 for as long as we can. People invest like 50, 100, like 500, like it really varies. So people come to us in different walks in life for different goals. And as far as returns, typically when you're on the equity side, call it, you're a part owner, we try to give a steady kind of cash flow. We buy these communities that are cash flowing. So around 6 to 8% per year of cash flow. And then the actual return itself, aggregate return around 15 to 20%. So the kind of ballpark that we want is like, we want to double your investment every 5 years. We kind of use that as a underwriting goal to be like, hey, we're looking at this property here in Virginia. This is the price that we can offer so that we can do this and help our investors this way. That's also why we barely have any deals, which kind of sucks. Our investors are always like asking like, hey, when's the next deal? When's the next deal? And for us, just philosophically, like we don't want to deploy capital to just deploy capital, because we're the operators as well. We're running a team that actually is managing the property day to day. We know how much work it is. And if you don't buy right, then you're basically trying to climb out of a hole you dug yourself into. So we choose to stay patient and, make sure that we're presenting good opportunities to our group.
I'm sure people appreciate that due diligence.
Yeah.
Because too busy to always do that ourselves. But ultimately, that's what makes a good investment, right? Is doing that. So just want to make sure I kind of have it right. So when someone is invested in, it sounds like they're getting cash flow coming back from rental or whatever being collected there. That's almost like a dividend that they can expect to receive. You mentioned kind of annual returns. Like, are you ever selling the properties and cashing out? And does that go back to the investors as well? Like, how far does it go?
Yeah. So when you're an equity owner, you partake in everything. So you get the cash flow at refinance, you get your basis back at the sale, you get a part of that as well, and you get the tax benefits. So one thing that, I didn't mention before is that mobile home parks have a huge tax advantage to them when it comes to depreciation. So as a part owner, you partake in all of it. There's another offering that we do sometimes as well, is that you're going to be a private lender. For people that they want their position to be more on the lender side, you could be the bank and you can make a much higher return than you do typically. And that's like between, 8 to 12%. And that's just like dividend, like monthly.
I'm assuming you'd have to be an accredited investor to go this path because it's private equity, right? For someone who's not as familiar with that, can you explain what it means to be an accredited investor, kind of the steps might look like for them to get involved here?
Yeah, two things. So one, the accredited investor, that designation, I mean, you'll see it listed on the SEC. A couple of the most common ways is to earn enough or be worth enough. So if you earn 200 to 300,000 or more, depending on if you're a single or a couple, that qualifies you, or you're worth $1 million or more outside of your primary residence. That's also how you qualify. Or if you have the professional designations like you're a Series 7 or things like that, I would say obviously like check with the SEC website, because for us, when we're offering securities, like we're just governed by the Securities and Exchange Commission. So follow them for like the most up to date and most clear ways.
You've done a great job explaining the investing side. I think that's pretty crystal clear. The only other question I really have on that is time frame of investment, because I know with some private investing, there's usually a multi-year engagement that you're expected to do. But besides that, I am kind of curious just about this area. Now, maybe a lot of people are probably not thinking about this as an investment option. Maybe they look at REITs, or maybe they think of renting out their home eventually. Maybe they think of a condo, or maybe a short-term rental, like an Airbnb thing. But what do you want people to know about this that maybe they haven't thought about?
The one thing about private equity in the private markets is that you're going to be in it for some time. So when we sort of compile together a group of investors to buy a property like this, then we're in it, we're running the business plan. So it's not like, hey, my daughter's wanting a new car. Like, can I get my money back? That's not happening. It's much more difficult. Yes, I mean, you could sell your shares to someone else, but you have to be patient. And this is not financial advice, but like typically, when people look at their financial household, they want to diversify, put a little bit here, put a little bit there. Maybe some is like rainy day funds, some is in stocks, some is in more illiquid private equity that grows a lot more, is more steady, etc. So it just really depends. People have different allocations to it. But yeah, knowing there's that illiquidity aspect is very important.
So Leo, if you could go back and meet yourself when you were younger, maybe back when you were working at Tesla earlier, what would you tell yourself? Like, is there anything you would have done differently? Like, how do you feel you would have helped yourself in that journey?
Yeah. I would definitely not have left my job so early. So I started investing passively, and then I just caught the real estate bug immediately. And, being young, I was like ambitious and I was hot headed. So I was like, yeah, screw it. I'm just going to go off on my own and do this. Yeah. Because I know I have the capacity for work and whatever. But it's super valuable to have that stream of income and then use that stream of income to build yourself another stream of income, because I would have achieved far more financially if I just did that and then tested entrepreneur on the side. I would let the endeavor prove itself rather than the other way around. So staying at that job, and then when you do go off on your own, just swallow your ego, work for someone that's going to be more experienced and knows what they're doing to shortcut your growth. Because I had to learn so many things the hard way unnecessarily. I should have just joined a group.
That's amazing advice. I love that. What other financial moves are you making for yourself personally? I imagine you're diversifying in some other ways. What are the big moves that you're making?
So for me, I always like to take my cash and make it into cash flow. I like cash flow. So, I invest with other groups as well. That way, like all of my eggs are not in one basket. So, being open to other opportunities like oil and gas, or like a warehouse, or, something like that, RV parks, different things. I think that in one way makes me a better investor as well. Because, knowing what I know now, how operations is, how people underwrite deals, I know what questions to ask other, general partners to just get an idea of what's going on. The one thing I will share, just being in my position, that I learned that was super helpful is trust your gut. I've learned to trust my gut a lot, because your gut is developed from basically thousands of data points that you don't even notice. It's like, oh, hey, if this happens, that will happen. And like it stores it inside. So, when talking to investment groups, kind of like seeing who they are, one thing is access to the actual people that make the decisions. I don't want to go through like an investor relations person that just gives me a fluff piece. I don't know what's going on. Like I want to know like what's happening with my money. I'm that guy that like, I might not cut him a big check, but like, I do want to know what's going on. So, that takes away a lot of options from that regard.
All right. Last question. How do your parents feel about your success and how far you've come?
They've been happy. Not to say that they don't have standards for me, because they just want me to be happy.
Right.
So it's easy and it's also impossible at the same time because, happiness is a feeling. So it's like, okay, they have no expectations of me, but they also want me to be happy about myself. And it's kind of like a circular logic because I'm happy if I could prove to them. So it kind of goes around. But I think we're going good so far. The beauty of life is that you kind of just learn and you become a better person along the way. So yeah, things are going well.
Some listeners would love to connect with you, Leo, or learn more about Cornell Communities. How can they do that?
Yeah, so two ways. One way, if you want to learn more about mobile home parks, investing with us and our team, maybe getting on our investor waitlist, you can go to our website, cornellcommunities.com. That's CornellCommunities.com. Or you can reach out to me on LinkedIn or Instagram. On LinkedIn, it's Leo Young, LeoYoung. On Instagram, it's Leo Young Real Estate.
Wonderful. Well, thank you so much for teaching us about this. It really was lovely meeting you and learning about your journey and all of your success. And I wish you more of that. And thank you for coming on the show.
Yeah, thanks so much, Dan. And to the listener at home, I implore you to do this. Just take one thing and take one piece of action from this. It's very easy to listen. I know I've been there, but to actually take that step, that's what's going to change your life. And your future you will thank you.
+1 to that. Thanks again, Leo.
Thanks, Dan.
If my career was a room, then it was a padded room where I continuously bounced off the walls. My average time at a job was 2 years. And it wasn't because I ran out of opportunities. It was because I hit a ceiling with what they'd pay me. The effort it would take to break that ceiling just wasn't worth it. A role change or a massive promo, maybe a new certification or even a business degree. The ROI just wasn't good enough for the effort it would take to hit my goals. So switching jobs became part of the playbook. And my data showed that it worked. I'd get a promotion, earning somewhere between 8 and 16% more. And then within the year, I'd start a new job, logging in another raise. When I left Ohio to start a job at Microsoft in Washington, my pay increased 80%. I thought I was done hitting ceilings. But the truth was, I was actually hitting them more often, and all within a mega corporation. I continued to chase the next title, the next raise, the next level. And I was actually pretty good at it. But I have to be honest, that grind wasn't what actually got me to my exit. Normally, more income just means more spending. It was actually my strategies, the ones that took those wages and turned them into additional income, that did the trick and eventually let me escape the grind. Because here's the thing that nobody tells you when you're climbing. A paycheck, even a great one, it's just the fruit. And if all you do is pick fruit, then you're at the mercy of the tree, the season, whoever owns the orchard. That is the heart of what Leo Young is doing. Leo learned this the hard way at Tesla when he was the #1 regional salesperson during a stretch when the company was fighting for survival and everyone was grinding themselves to dust. He looked around and realized something so simple and kind of brutal. He was working for money, but the people who were getting wealthy, they were the one that owned the machine. And the data backs him up completely. A Federal Reserve Bank of Richmond study showed that the single largest asset for those households in the middle of the wealth distribution was almost entirely their family home. It is only at the very top that stocks and private business equity finally outweigh the house. So the middle class buys one asset, their home, and then typically stop. At best, maybe they're putting money into a 401k, hopefully some savings. But the wealthy, they own the businesses, they own the equity, the machines. So the gap isn't really about income, it's about ownership. So Leo went looking for a machine that most people overlooked. And he found it. He found it actually in the last place that anyone really romanticized finding one, which is manufactured housing commutes. And before I learned all that I have, if someone had told me a top Tesla salesman made it big by selling mobile home parks, I just wouldn't have believed them. But it actually makes sense. He saw a chance to own a fruit-bearing tree of his own, because no matter how much fruit Tesla bore, he had no control over it. He was tied to the handouts. While trailer parks aren't the sexiest investment, here's why his move is so clever. It is the lowest cost form of housing in America that the government does not subsidize. People cannot move down from there, so the demand never disappears, even in a recession. Because the residents own their homes, the operator just owns the land and the infrastructure underneath. You maintain the roads and the utilities, the cash flows. But it can be a cold business model. And some can just miss the best thing about it, because when you do it the right way with the right reasons in mind, owning and operating these communities can be a way to support the people who need it most. And I want to give Leo some real credit for his part in that, because he made it clear that he did not see his residents as a line item. A lot of these parks are 50, 70 years old. When the infrastructure is left to rot, the places get condemned, and 50 families would then get displaced into housing that they can no longer afford. Leo's whole model is to buy those communities and revitalize them, keep them dignified and keep them affordable, and still earn a real return. That is the rare deal where doing the right by people and doing the right by investors point in the same direction. And the mechanics are simple here. You buy a cash flowing community, you aim to roughly double the investment over about 5 years. It's a kind of diversification that almost no financial advisor will suggest, because it doesn't bring new assets under their management. So as long as you have the capital to reach accreditation, you're okay with making an illiquid investment, it is a strategy that can produce some fruit. But I want to be clear that it isn't the only way. There's actually many ways to get into this type of investment and many others. And because there are so many ways to take our hard-earned money and turn it into a replacement paycheck that allows us to leave work, we can all have an option that works for our risk tolerances and for our goals. Leo found a strong business model that worked for him personally, and we have to do the same thing for our plans. When I asked him about his one big regret, though, he told me that if he could go back, he wouldn't have quit working at Tesla so fast. And that honestly caught me by surprise. But his reason is sound. It's easy to see a quick escape, especially when we're burned out with our work. But he realized that he could have used more of his wages to bootstrap things better. Now, of course, you have to be careful there, because many times it's the opposite problem. We're delaying leaving indefinitely, pushing for another paycheck or another raise or bonus or whatever it is. And that just keeps those golden handcuffs on really tight. But what he was hinting at is this Goldilocks moment. One where we can find in our plan a perfect balance between knowing that we've finally put away enough to move with confidence into that next phase without regret. Overall, I want to leave you with one last thought for this episode. The paycheck is not the enemy. It doesn't have to be the whole golden handcuffs that are keeping us burned out at work. It's the fuel that we need for our escape. It's that fertilizer that we use to enrich the asset-bearing trees that let us all live our best lives. So consider planning how to shift some of those W-2 wages into your own Escape the Clock plan to build your own orchard. Just remember to review it with a professional before making any major moves. I'd love to hear from you. What is the one asset you could start owning a piece of this year? Not for what it pays you, but for the freedom it buys you later. Email me at contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thanks for listening, and best of luck building something that pays you back, escaping the clock. I'll catch you next week. That's a wrap on this episode of Escape the Clock. Everything you've heard today is for educational purposes only, designed to help you think, plan, and build a stronger financial program. Take what resonates, bring it into your Escape the Clock plan, and review it with a qualified professional before making any major moves. I'm Daniel C. Rogers, a wealth management certified professional and your host. The book, the free planner, and the one-on-one time with me are all waiting for you at EscapeTheClock.com. If this episode was valuable, please leave a rating, share it with someone who needs to hear it. I'll catch you next week.